Good day, fellow investors. The most requested stock for me to analyze in the comments was Adobe. And this is usually the case. Everyone wants to know about it when there is a stock that goes up, and then suddenly starts going down. And everybody wants, okay, I want to know here, Sven, whether it will go up now or down. Let's make an analysis. What's the value? And let me try to help you there in making that decision by analyzing Adobe. If you like this stock analysis, smash that like button, and also don't forget to comment which other stocks you might want to see analyzed. Those that are on the top of the comments with most likes and comments confirming everything will certainly come on my to-do list. So let's discuss Adobe. The market cap 186 billion, the price earnings ratio 39. Let's see what's going on and whether it is a buy or not. Now first, Adobe really looks like a great business. Software as a service, so you make a product, you make a few products here, and then the more customers you get, your cost basis doesn't really increase, which means you're increasing margins. And you can see that here revenues have a little bit more than doubled. Gross profits are really high and the cost of revenues are really small. You always want the leader in the industry, especially in these times, and these high margins also indicate a great business. Then if we look at revenue per share, as said, a little bit more than doubled, but earnings per share have tripled. As said, that is the scaling power that these companies have. So we cannot say that Adobe is not a good business, whether that is a double negative or not. So we all know it, we probably all use it. I'm not a customer, I use it to open my PDFs, but I'm still not paying anything, so I managed to do that, so who knows. But the scaling power, the everything, really shows that Adobe is the leader, is the quality, is the everything, so really a great business. We cannot say nothing against it. Yes, and then you say, Sven, yes, great business, but it is down 40%. What to do now? Is it a buy now? Do we need to accumulate great businesses at fair prices? Well, let's make our usual valuation. For valuation, revenue will be flat likely for Q2, so likely there will be some growth. Earnings, so we have GAAP earnings, but analysts are using these earnings. I didn't dig deeper into what are these adjustments, but likely short-term or temporary adjustments. Nevertheless, we are at 10 here for earnings to use for our valuation. I have looked a little bit here, so a little bit higher, free, so we should have earnings around 13. And those are the factors we use in our valuation table. You can check here the intrinsic value explanation and also download my table in the link in the description below. Earnings and growth rate are the key when it comes to valuing Adobe. So here is my free downloadable investment table. You can find here the links to all the previous analysis. I'll fill this up now and then I'll upload it so you can download it directly in the link in the description below. Now I have made a new sheet here for Adobe and then we'll fill it out together in this case. Here is the stock price, and then we put an input here, and then let's use earnings per share as a good input. Now around 10 now, but given the adjustments and everything, let's say 14 that are the real earnings, and then those grow at, let's say, 10-15% per year for the next 5 years, and then 10% for the next 5 to 10 years. The discount rate, my expected return, 10%, let's say, and then the P/E ratio down the road. I'm happy with the P/E ratio of 15 for such a great business, let's say, and then my intrinsic value. Of course, they are not paying out these dividends, the earnings, so they are reinvesting for growth, so we can't count that twice, so I delete that because the EPS is reinvested for growth per share if they do buybacks, and they do some. So the intrinsic value for a 10% expected return is 238, which means that at these growth rates, 15%, the stock price is too high. Let's see a best case scenario. Let's put 20% growth in earnings, 15% for the future, and then let's put a 25% terminal multiple as this business should deserve it. Then, yes, then the present value is much higher, and then this is undervalued for the situation. But you really should have 20% growth possible, however, given the tech slowdown, very, very hard. Worst case scenario, let's say 8% growth and then 5% growth. The market doesn't like it. Terminal multiple of 12. They keep reinvesting. We delete here. And then you have another 70% downside possible. So this is the normal scenario, best case and worst case scenario. Let's see what Morningstar says. Their fair value is close to my best case scenario, and the assumptions are for price to sales of 16 times, that's the PE ratio I used, adjusted PE ratio down the road of 44 times, and a 2.6% cash flow yield. These valuations are, yes, good in an exuberant growth market, but if that reverts to the mean, which happens sooner or later also with growth companies, then you are in an ugly place. Analyst estimates are for earnings to more than double over the next 3-4 years. If that happens, then yes, it continues to grow and it fits the best case scenarios, but I don't think that what they are modeling here could happen. Tech is slowing down, so this should be, yes, the estimation in the past, but now maybe saturation, maybe this, perhaps we have all been too exuberant with this tech growth stocks, and this is the main thing in the valuation. If this is lower than expected, so slowing down, but let's say 7% in 2026, not 14%, that will be ugly for the stock price. So for me, definitely this is still too risky, but I just wanted to explain what is the risk and reward. The stock was clearly part of the exuberance tech trend starting here and then booming and now just returning to where it was already exuberant. So this spike up here, and now it's just cooling off, and you never know when will this cool off. It is a P ratio of 40, market cap 186 billion on earnings of 12 billion down the road, so a P ratio of 15 in 2025. So if they hit the growth rates, so that's really, really risky, and you never know whether they will be able to do that. That's the risk and reward. You have to see whether the business is that good that it will sustain these incredible growth rates or not. It seems that we have accelerated the tech boom due to the pandemic, everyone going tech, 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 but it seems also we are there in a moment where a lot of these things have reached saturation, and we'll see how it will develop. Yes, Adobe is saying that their total addressable market is 200 billion, etc., etc. We'll see about that in the future. Let me know in the comments whether you think that there is quality in the business, there is no competition, and there is really demand for the products to really keep on growing at these incredible rates. Thanks for watching. I hope you enjoyed my opinion. Smash that like button and let me know in the comments for more suggestions.